When you think about wealth, real, lasting wealth, what comes to mind? Is it the thrill of a fast profit, a sudden market rally, or that dream of becoming rich overnight? For many new investors, the idea of financial success is often tied to speed. The faster you make money, the more successful you are. At least, that's what the modern world tries to convince us. But in reality, those who truly win in the world of investing, those who build wealth that lasts for generations, play a completely different game. Their power does not come from luck, timing, or speculation. It comes from something much simpler, yet far more difficult: patience. This is the philosophy that has shaped the greatest investor of all time, Warren Buffett. With a net worth exceeding $100 billion and a legendary career spanning more than 70 years, Buffett has built his empire not through rapid trades or risky bets, but by letting time do the heavy lifting. His secret weapon is not intelligence, though he certainly has plenty of that. It's not even access to insider information or secret tips. Buffett's greatest advantage is the ability to wait that in a world driven by instant gratification. His mindset almost feels radical. The average trader buys and sells stocks within months, or even minutes, hoping to catch the perfect wave. Buffett, on the other hand, buys great companies and holds them for decades. "Our favorite holding period is forever," he famously says. This long-term approach is the embodiment of the most powerful force in finance, compounding. Albert Einstein reportedly called compound interest the eighth wonder of the world. It is the simple idea that wealth grows not just from returns, but from returns on those returns. Over long stretches of time, compounding can turn small amounts into enormous fortunes. But here's the catch: it only works if you stay invested and remain patient. A long-term mindset is the key that unlocks compounding's full power. It rewards those who wait. And it punishes those who cannot. But why is patience so difficult, especially in the financial world? The answer lies deep in human psychology. We, as humans, are wired for survival, not investing. Our brains crave certainty, excitement, and control. We are far more sensitive to losses than gains, a concept known as loss aversion. Losing $100 hurts more than gaining $100 feels good. So when we invest money and the market dips, even slightly, our instincts scream, "Get out before it gets worse." This emotional reaction leads many investors to sell at the wrong time and buy at the wrong time. Panic selling during downturns. Chasing hype during bubbles. These behaviors destroy long-term wealth. Buffett sees the market differently. To him, a market downturn is not a threat, it's an opportunity. "Be fearful when others are greedy, and greedy when others are fearful," he says. This mindset is only possible when you take a long-term perspective. You stop seeing volatility as danger and start seeing it as a natural, and profitable, part of the investing process. Short-term traders often feel stress, pressure, and emotional exhaustion. Their financial success depends on perfect timing and constant monitoring. It becomes a battle of prediction and reaction, a battle they often lose. In contrast, long-term investors enjoy freedom. They do not need to watch the market every day or react to every piece of news. They focus on the underlying value of the businesses they own, trusting that value will grow over time. It's a calmer, more rational approach, one that benefits both mind and wallet. But here's what most investors overlook: long-term investing is not passive. It requires strength, discipline, and emotional resilience. Holding a stock through highs and lows, through uncertainty and fear, is not the easy way out, it's the smarter way through. Buffett himself has endured countless market crashes, recessions, and moments of panic. Yet he remained steadfast because he understood that short-term pain is part of the journey toward long-term gain. One of his greatest lessons is this: price is what you pay, value is what you get. Short-term thinkers obsess over price movements. Long-term investors focus on value, and value compounds over time. That's why Buffett buys companies with durable competitive advantages, trustworthy leaders, and strong business models. He's not interested in what the company will earn this quarter, He's thinking about what it will earn 10, 20, even 50 years from now. This long-term philosophy has also shaped Buffett's calm attitude toward market chaos. During the 2008 financial crisis, while others were panicking, he was investing billions in companies like Goldman Sachs and General Electric. He saw fear as mispricing, and mispricing as opportunity. Fast forward a decade, those investments multiplied in value. Wealth was transferred from the impatient to the patient, and that's the ultimate truth: the market is a machine that rewards patience. It transfers wealth from those who try to get rich quickly, to those who are willing to get rich slowly. The long-term investor is not playing against other investors. They are playing against their own impulses. Slow is smooth. Smooth becomes fast. Fast becomes dangerous. The real challenge is not beating the market, it's beating your own emotions. Every great investor understands this. But perhaps no one has demonstrated it more powerfully than Warren Buffett, whose life is a testament to the idea that time is the greatest wealth builder in human history. The lesson is clear: if you want to build wealth that lasts, if you want financial freedom that endures, if you want money to work for you instead of you working for money, then you must do what so few are willing to do. Think long-term. Be patient. Let compounding change your life. This is only the beginning of our journey into the psychology, strategy, and true power of long-term investing. In Part 2, we will dive deeper into the science of compounding, how it works, why it matters, and how even small investments can grow into great fortunes when given enough time. Investing is not a race, it is a marathon, and the one who finishes wealthy is rarely the one who starts fast, but the one who never stops moving forward. The psychology of risk: why most investors FAI. Risk. It is a word every investor hears, yet very few truly understand. Most people see risk as the possibility of losing money. But great investors, from Benjamin Graham to Warren Buffett and Charlie Munger, see risk differently. To them, real risk is not no. It is ignorance disguised as confidence. A game of excitement. The game of wealth. Risk is not the same run before it gets worse. But if you can't handle a little pain, Munger knew the price of admission for long-term gains. Imagine overconfidence. Many investors believe they know more than they actually do. They trade often, make predictions, and assume intelligence equals market success. History proves otherwise. Smart people lose money all the time. Why? Because markets are smarter than individuals. The world is too complex for confident predictions. Munger understood this deeply. He built his philosophy around avoiding stupidity instead of seeking brilliance. It is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid, he said. Managing risk isn't about heroic bets, it is about avoiding obvious disasters. That's why Munger loved checklists. Pilots use checklists for one reason: mistakes kill. In investing, mistakes kill wealth. Munger's system forced him to question his assumptions, search for opposing views, and remove emotion from decision-making. The average investor does none of this. They fall in love with narratives: a hot tech stock, a hyped cryptocurrency, a charismatic CEO. Excitement replaces logic. Hope replaces analysis. And when reality fails to match the story, wealth evaporates. But how do great investors resist these psychological traps? They change the time horizon. Short-term results are controlled by emotions and randomness. Long-term results are controlled by fundamentals and discipline. When the focus shifts from days to decades, fear loses power. Risk becomes clearer. Opportunities become visible. Munger once explained that if you can delay gratification, if you can be patient while others panic, you gain a massive advantage. He compared the stock market to a casino where you win not by playing every day, but by waiting for the perfect moment to bet big on a sure thing. This method is known as selective aggression. Do nothing most of the time. But when a rare, amazing opportunity appears, act decisively. The average investor does the opposite: they are aggressive constantly, and cautious when they should be bold. Another key factor is circle of competence. Munger taught that you should only invest in what you truly understand. Knowledge reduces risk. Ignorance multiplies it. Most people buy stocks with no understanding of the business. They take risks blindly. Munger avoided industries he couldn't grasp. That's why Berkshire Hathaway rarely invested in cutting-edge technology in its early decades. Not because tech wasn't profitable, but because it was unpredictable. He preferred stable businesses with durable competitive advantages, companies that would remain profitable regardless of market hype or economic cycles. True investing is not gambling. It is ownership. And owning a great business is one of the safest ways to build wealth, if you ignore the market's mood swings. But perhaps the most powerful risk management strategy Munger used was the margin of safety, buying assets far below their intrinsic value. This principle, borrowed from Benjamin Graham, creates a buffer against bad luck, mistakes, or unforeseen crises. If you buy with a margin of safety, even if something goes wrong, chances are you still won't lose. Without it, even a small surprise can be financially devastating. Most investors ignore margin of safety because it requires patience, and patience is rare. They would rather chase stocks that are already expensive because it feels safer. But the feeling is fake. Safety lies not in popular assets but in undervalued ones. A final psychological challenge is social pressure. Humans hate standing out. We want to be part of the crowd. But in markets, the crowd is usually wrong, especially during bubbles. When everyone is euphoric, danger is highest. When everyone is terrified, opportunity is greatest. Munger said that being a great investor often means looking wrong to the crowd, sometimes for years. Few people can endure that social discomfort. They abandon their strategy before it works. The difference between success and failure is not intelligence, it is temperament. So how do we put Munger's wisdom into action? First, accept that risk can never be eliminated, only understood. Second, focus on what you know. Third, ignore short-term noise. Fourth, demand a margin of safety. Fifth, stay rational while others are emotional. Investing is a battle between human instincts and human intelligence. Most lose because instincts are louder. Munger built wealth by mastering his mind first, and market second. He understood that patience is a superpower, discipline a shield, and knowledge a compass. Risk did not scare him. Risk gave him opportunity. In the next part, we will explore how Charlie Munger partnered with Warren Buffett to build one of the greatest investment empires in history, by redefining the very meaning of risk and reward. The world sees volatility as a threat. Munger saw it as the gateway to freedom. Charlie Munger and Warren Buffett, transforming risk into reward. Charlie Munger and Warren Buffett did not become legends by following the crowd. They became legends by changing the rules of the game. Before they met, Buffett was already a student of Benjamin Graham, buying extremely cheap and struggling companies, waiting for prices to rebound, then selling for small profits. It worked, but it was limited. Graham's approach saw stocks as mere numbers on a balance sheet. Munger saw them differently. To him, a stock was a piece of a business, a living organism with customers, advantages, culture, and a future. And a great business was far better than a mediocre one, even if not the cheapest. When Buffett and Munger met in 1959, something powerful happened. Buffett once said, "I was like a hungry man finding a banquet." Munger expanded Buffett's mind. He convinced him that quality matters, that paying a fair price for a great business leads to much bigger success than buying junk simply because it's cheap. This idea became a cornerstone of Berkshire Hathaway's rise. They shifted from buying cigar butts, companies with one last puff of value, to buying exceptional companies capable of compounding wealth for decades. This shift was not just a financial strategy, it was a philosophy of risk. Great businesses reduce risk because their future is more predictable. They have strong brands, loyal customers, pricing power, and leadership that creates value year after year. Risk is lower when the compounding machine is powerful. The early years of Buffett and Munger's partnership were filled with bold decisions. One of the most famous was buying See's Candies in 1972. On paper, it looked expensive. Graham would have rejected it. But Munger saw the power of its brand and loyal customer base, a product nearly immune to competition because it had become a tradition in people's lives. That purchase became one of the greatest investments in American history, a living example that quality beats cheapness over time. Munger's influence also pushed Buffett to pursue businesses like Coca-Cola, American Express, Duracell, Apple, and many more icons that dominate their industries. These companies generate cash even in recessions. They weather storms. They turn risk into resilience. Buffett once admitted, "Charlie dragged me into investing in wonderful companies." Munger didn't drag, he enlightened. Together, they realized that the best investment strategy is not avoiding volatility, but embracing great businesses through volatility. Another element that defined their partnership was simplicity. They avoided complicated investments. If they could not explain how a business made money in one sentence, they passed. While others chased high-tech trends and financial engineering, Munger and Buffett kept asking the same basic questions. Does the business have a durable advantage? Are the managers honest and competent? Will it still be winning in 10, 20, 30 years? Can we buy it at a fair price? This resistance to trend chasing protected them from some of the biggest economic disasters in modern history. During the dot-com bubble of the late 1990s, the world mocked Buffett and Munger for avoiding internet stocks. They were called old, outdated, clueless. The crowd said, "This time is different." The bubble burst. Trillions disappeared. Berkshire Hathaway emerged stronger than ever. Why? Because avoiding stupidity is a form of genius. Munger often said, "All I want to know is where I'm going to die, so I never go there." In other words, figure out what causes failure, then avoid it diligently. That single mindset protected investors from more losses than any prediction ever could. Another remarkable part of their success is their long-term alignment with shareholders. They never promised quick returns. They told investors to think in years and decades instead of days. They refused to split the stock to make it cheaper, because they wanted only serious, patient shareholders. Risk decreases when you are surrounded by rational thinkers. They preferred a small group of loyal partners over a massive crowd of emotional traders. And that decision shaped a culture where long-term thinking thrives. But perhaps the most powerful thing they mastered was emotional discipline. Both understood that the stock market is a machine built to test human psychology. Every day, investors are offered prices, some tempting, some terrifying. Most people react emotionally to those prices. Buffett and Munger trained themselves to respond intellectually. When fear took over the market, they saw opportunity. When greed took over the market, they stepped back. Munger once said, "The big money is not in the buying or selling. It's in the waiting." That statement contains more wisdom than entire books. Waiting is the ultimate financial strategy, because time amplifies good decisions and exposes bad ones. They famously held investments for decades. Coca-Cola became a core holding for over 35 years. Their patience allowed compounding to work its quiet magic. Many investors understand compounding mathematically but fail to benefit from it emotionally, because they cannot sit still. Buffett and Munger turned boredom into profit. Their partnership also thrived on relentless learning. They were humble enough to change their minds. Before meeting Munger, Buffett's style was rigid. After absorbing Munger's philosophy, he evolved. Great investors do not cling to old beliefs, they upgrade them. They read constantly, studied history, examined mistakes, and analyzed human behavior. They built what Munger called a latticework of mental models, a toolkit of principles from psychology, economics, physics, and biology to make better decisions. Instead of asking, "Is this stock going up?" which is gambling, they asked, "How does this business survive and win?" They avoided narrow thinking. They embraced multidisciplinary logic. That's why they understood risk differently. To the crowd, volatility equals danger. To Munger and Buffett, volatility equals mispriced opportunities. Fear creates bargains. Panic creates fortunes. But only for those prepared. And preparation is a lifelong habit. Their partnership wasn't perfect. They made mistakes. Buying Berkshire Hathaway itself was a huge regret, mainly because the textile business was dying. But they learned from it. Never invest in a bad business just because it's cheap. Every failure became a lesson written into their investment DNA. Their humility, honesty, and humor made them loved by millions, not just for their wealth, but for their wisdom. People didn't admire them because they were rich. They admired them because they seemed to know how to live, simply, rationally, generously. They showed the world that investing is not a game of numbers, it is a reflection of character. And when character meets discipline and patience, extraordinary results follow. Today, Berkshire Hathaway is one of the most successful companies on earth, not because Buffett and Munger avoided risk, but because they redefined risk. Real risk is not market drops. Real risk is owning bad businesses. Real risk is letting emotions guide decisions. Real risk is impatience, the silent killer of wealth. Buffett once summarized Munger's greatest gift: he has the ability to destroy my most cherished ideas. In other words, Munger protected Buffett from Buffett. We all need someone who challenges us, who stops us from being our own worst enemy. Because in investing, the enemy is often inside us. In the next part, we'll explore Munger's famous decision-making framework, the mental models behind his clarity, and how applying them can change not only your investing results, but your entire life. Charlie Munger didn't just master money. He mastered thinking. And that is the greatest reward of all. The mental models that reduce risk and multiply wealth. Charlie Munger believed that success in investing depends on one thing above all: the ability to think better than the crowd. Not faster, not with more data, not with fancy technology. Just better. Because the market eventually rewards rationality. Munger's greatest contribution to investing is his concept of mental models. Instead of relying on a single economic theory or memorizing formulas, he created a toolbox of ideas drawn from psychology, engineering, mathematics, biology, and history. The world is too complicated to be solved with only one perspective. Most people with hammers treat everything like a nail. Investors with only one model treat every situation the same. Munger refused to be blind. He believed a good investor must understand the world the way it actually works, not how they wish it worked. And so he built a multidimensional way of thinking that significantly reduces risk and increases the probability of success. Let's explore how these mental models shape investment decisions and emotional discipline. One of his most famous models is inversion. Instead of asking, "How do I succeed?" Munger asked, "How do I fail?" Then avoided every path that leads to failure. He often joked, "All I want to know is where I'm going to die, so I never go there." Inversion protects investors from the biggest dangers: leverage without understanding, chasing hype, emotional decision-making, and owning fragile businesses. It cuts through illusions and forces realism. Another key mental model is the circle of competence. Munger believed that investors should only operate in areas they truly understand. Straying into industries you cannot explain is like flying blind into a storm. Most people overestimate their knowledge. They buy stocks because someone else made money in them. They follow trends they don't understand. They assume intelligence in one field automatically transfers to another. But the market exposes weak understanding mercilessly. Buffett once said, "What counts is not how big your circle of competence is, but knowing its boundaries." Staying inside your circle dramatically lowers risk. You avoid surprises. You avoid sharks in waters you've never swam in. Munger also mastered probabilistic thinking, the idea that every decision is a bet. Investing is not about certainty, It is about odds. Smart investors estimate possible outcomes and choose those with favorable risk-to-reward ratios. They don't need to be right every time. They just need to avoid situations where being wrong means ruin. This thinking saved Buffett and Munger from chasing once-in-a-lifetime opportunities that destroy fortunes when they go wrong. Risk is not the possibility of loss. Risk is the possibility of permanent loss. Decisions must protect survival first, reward second. Another critical model came from psychology, avoiding cognitive biases. Munger spent his life studying the ways our brains trick us into bad choices. Confirmation bias makes us seek information that proves we're right. Social proof makes us follow the crowd even when the crowd is insane. Overconfidence makes us take risks we don't understand. Loss aversion makes us sell winners early and hold losers too long. Munger turned self-awareness into a weapon. Instead of pretending to be perfectly rational, he assumed he was biased and designed processes to compensate for it. Other investors believed they were smart. Munger believed that being aware of your stupidity is even smarter. Knowing what you don't know is more useful than being brilliant. This humility helped Berkshire avoid reckless gambles. It helped them stay calm while others panicked. Good investors don't fight human nature. They manage it. Then there is the power of incentives. Munger always warned, if you want to understand why people behave a certain way, look at the incentives. Incentives shape actions more than morals or intentions. If a CEO is rewarded for short-term profit, he will ignore long-term health. If a banker is rewarded for making loans, he will make dangerous loans. If investors are rewarded for constant trading, they will take reckless risks to show short-term success. Munger sought companies with honest incentives, where managers win only when shareholders win. That alignment reduces hidden risk. It turns leadership into guardians of value instead of gamblers. One of Munger's deepest insights is the importance of moats. A moat is a competitive advantage that keeps the business safe from competitors. Coca-Cola has a brand moat. Apple has a product and ecosystem moat. Amazon has a scale moat. Disney has a storytelling moat. A company without a moat is a castle built on sand. It may look strong, but the tide of competition will eventually wash it away. Moats turn businesses into compounding machines, consistently increasing profits with minimal risk. Munger wanted to own not good businesses, but unbeatable ones. That mindset alone separates amateurs from icons. He also valued redundancy and margin of safety, always leaving room for error. Engineers build bridges to hold far more weight than needed. Investors should build portfolios that survive worst-case scenarios. If success requires perfection, risk is unacceptable. Munger insisted, don't rely on luck. Don't assume smooth sailing. Assume storms will come and build accordingly. Every bet should allow recovery if wrong. Margin of safety is not a number, it is a lifestyle. Perhaps the most fascinating element of Munger's mental framework is delayed gratification. Wealth is not created when you buy a stock. Wealth is created when you hold a great business long enough for compounding to explode. But humans crave excitement. They prefer action, movement, noise. Boredom feels painful. Munger taught that boredom is profitable. Impulse is costly. Patience transforms time into capital. Compounding turns small snowballs into unstoppable avalanches, but only if you allow years to pass uninterrupted. This is where psychology meets money. To Munger, risk is not volatility. Risk is the inability to endure volatility. Big returns belong to those strong enough to sit still through uncertainty. Munger's thinking models do something extraordinary when combined: they prevent stupidity. They protect investors from actions driven by fear, greed, ego, or ignorance. And protecting yourself from stupidity is more valuable than trying to be extremely smart. It is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid. The mental models gave Munger and Buffett a superpower: the ability to remain rational when everyone else is emotional. During boom cycles, when the world is euphoric, rationality says step back. During crashes, when fear dominates, rationality says lean in. This discipline allowed them to buy wonderful companies when they were cheap. It allowed them to avoid bubbles that seduced billions. Risk is often assigned to external events, recessions, crises, inflation, but Munger understood that most risk comes from within. The impatient investor is his own worst enemy. Mental models protect against that enemy. And here is the truth, anyone can learn them. You don't need genius-level IQ. Munger himself said that success requires only a few simple ideas, followed with discipline. The problem is that simple is hard. People prefer magic. They want predictions, shortcuts, excitement. Munger offered none of that. He offered wisdom that feels boring but works every time. Avoid stupidity. Think clearly. Understand your limits. Invest in great businesses. Be patient. Let compounding work. This is how risk becomes opportunity. This is how average decisions turn into extraordinary outcomes. In the next part, we will explore how this philosophy shaped the long-term, generational success of Buffett and Munger, and how adopting their time horizon can change not just your finances, but your entire relationship with wealth and life itself. Because long-term thinking is not just a strategy. It is a superpower in a world obsessed with instant gratification. Long-term thinking, turning risk into generational wealth. Charlie Munger believed that the greatest edge any investor can possess is not found on Wall Street. It is found in the mind. A calm mind. A patient mind. A mind that sees beyond the present moment. Because the real enemy of wealth is not a market crash or a recession. The real enemy is short-term thinking. Across history, every major market panic has rewarded those who could keep their courage. During the crash of 1987, fear flooded the world. The stock market fell more than it ever had in a single day. But Buffett and Munger did not panic. They bought. They acted not from emotion, but from logic. They understood that the future of strong businesses does not disappear because the price falls temporarily. The market is a voting machine in the short term but a weighing machine in the long term. The market votes with emotion. Wealth is weighed by reality. Then came the dot-com bubble. Investors convinced themselves that profits no longer mattered. Traditional businesses were declared obsolete. But behind the curtain, many tech companies had no revenue, no product, no durable advantage. The bubble burst. Trillions evaporated. Yet those who owned real assets, strong brands, amazing businesses, survived with ease. Buffett and Munger were criticized for missing the hype. A few years later, the world realized they avoided disaster. That is how long-term thinking wins, quietly, without the need to be flashy. The 2008 financial crisis tested belief in capitalism itself. Banks collapsed. Panic spread. The future looked dark. But great businesses did not suddenly lose their value. People still drank Coca-Cola. They still used American Express. They still trusted companies with strong foundations. Buffett invested billions when others were frozen in fear. While short-term thinkers sold for survival, long-term thinkers positioned themselves for prosperity. When the recovery arrived, the rewards were staggering. And yet, Munger would say none of this required brilliance. It required emotional control. Most people are slaves to the moment. They believe fear means danger and excitement means opportunity. Munger learned the opposite. He once said the first rule of compounding is to never interrupt it. Selling because of fear interrupts compounding. Chasing hype interrupts compounding. Doubting the long-term power of great businesses interrupts compounding. Investors often talk about wanting enormous returns but cannot handle the boredom required to achieve them. Wealth grows quietly in the background while life goes on. Yet the human brain craves action. That craving is financial poison. Munger's genius was in designing a lifestyle and philosophy that minimized unnecessary decisions. Less action. Fewer moves. Deeper conviction. Great patience. Most investors lose money not because they lack knowledge, but because they lack time. They quit too early. They sell too soon. They panic too fast. Munger believed that wealth, like a tree, must be planted once and protected always. It does not grow faster by digging up the roots and inspecting them. It grows through seasons, both sunny and stormy. In his late years, Munger began reflecting not only on wealth, but on the meaning behind it. He built systems meant to outlive him. Investments designed to flourish decades beyond his life. He did not seek wealth for personal luxury. His life was shockingly simple. No fancy cars. No extravagant estates. No obsession with status. He understood that money is only valuable if it increases the quality of life, not just today, but for future generations. Long-term thinking is an act of love for the future. Buffett and Munger learned that the best investments are not numbers on a screen, they are ideas that shape the decades ahead. A child's education. A great company that creates jobs. A product that improves life. A business model that will remain useful for 30 or 50 years. Munger warned investors about a dangerous trap, mistaking recent events for permanent truths. If prices rise quickly, people assume they will always rise. If markets crash, people assume they will never recover. This blindness leads to buying high and selling low, the exact opposite of wealth creation. The long-term thinker sees opportunities nobody else notices. When crowds run, the long-term thinker walks forward slowly. When crowds rush in, the long-term thinker steps aside. In this calm behavior lies the secret to fortune. Patience amplifies advantage. Risk dissolves when given enough time. Survival becomes success. Charlie Munger's entire philosophy can be summarized as follows: don't rush. Don't follow the crowd. Avoid stupidity. Invest in what will endure. Accept that time is the real engine of wealth. Munger spent his life building mental habits that allowed long-term thinking to flourish. Models that kept him rational. Rules that protected him from emotion. Relationships that enhanced his wisdom. Reading that increased his competence. Reflection that strengthened his resilience. And through it all, gratitude shaped his perspective. He knew how fortunate he was. He valued the trust of his shareholders. He respected the effort of employees. He believed in responsibility, modesty, and generosity. His story reminds us that investing is not just a financial act, it is a moral act. It determines what kind of world will exist tomorrow. Long-term thinking creates stability. It rewards innovation that improves life. It supports businesses that treat people well. It helps society grow a stronger future. As Munger's life reached its final chapters, he never stopped learning. Never stopped observing. Never stopped refining his philosophy. Even near 100 years old, he was still reading books every day, still taking questions from students, still challenging ignorance with sharp humor and deeper wisdom. He once told young investors that if they spend their lives trying to be a little wiser every day, just a little, they will eventually be someone who becomes hard to defeat. Progress is quiet. Growth is invisible. Transformation is slow. That is the nature of compounding, of wealth, of wisdom, of life. And that is why long-term thinking is the greatest strategy of all. Because with enough time, the small becomes mighty. The patient defeat the impulsive. The sensible outperform the reckless. The disciplined rise above the unpredictable chaos of the market. And those who understand risk not as a threat but as a partner in the long journey toward wealth will build something far larger than financial success. They will build a legacy. Charlie Munger taught the world that the ultimate reward of long-term investing is not just money. It is peace. Freedom. Confidence. The knowledge that you do not need to react to every storm, because you are building something designed to outlast the storm. Time is the greatest creator of value. Patience is the greatest investment skill. Wisdom is the greatest profit. And risk, when understood correctly, becomes not something to fear, but something that shapes the path to greatness. The philosophy of Charlie Munger lives on in every investor who chooses discipline over excitement, rationality over emotion, and the future over the moment. That is how financial independence is built. That is how generational wealth is made. That is how the long-term thinker wins.